Everybody. Sorry, we were a little late getting started here. Hey guys, we are live. Sorry, we were a little late getting started here. I had a little technical difficulties here with the webinar, but we are here and we've got some participants. So that's good. Welcome everybody. Guys, what I figured I thought we'd do is we'd just introduce ourselves. So we can go ahead and get started with that. Let me get the slide up. Thanks everybody for joining. We're kicking off our first ever passive real estate meetup. And tonight we're going to talk about passive investment structures. So go ahead and get this going. We'll share the screen. We just wanted to, kick off this meetup. It's first time we've ever done it. My name is Ryan Gibson, and I'm the CIO with Spartan Investment Group. We have Tyler and Igor, who are also on. Say hello, guys.
Hello.
We are your hosts. We just wanted to, we kept this one pretty casual, but we also are diving into some topics. The reason why we started this meetup was because we want to increase investor sophistication. So there's meetups out there for flipping houses. There's meetups up there for wholesaling. There's meetups out there for doing your own deals or running your own business. This group is here to increase passive investor sophistication. So when you're looking at a multifamily syndication, a self-storage syndication, a development syndication like Tyler and Igor do, that's the type of deal that we want you to become more sophisticated on. This isn't a pitch fest with our deals. This is just a strictly an investor education opportunity. We're going to look at PPMs. We're going to look at waterfall structures. We're going to look at offering agreements or offering memorandums, operating agreements, things like that. So this is really, for the benefit of somebody who's thinking about investing passively. So, if you want a group to learn about flipping, there's some great ones, and I can recommend them. But this is mostly for limited members that are looking to invest passively in syndications.
And Ryan, before we go further, I think we just go back a little bit to an introduction. Part of the reason why we are here today is my name is Igor Pechkovsky. I work with Windermere Bellevue Commons. I'm a residential and commercial broker with Windermere. And over years, and the reason why we're so excited to be here with Ryan presenting on this, over years, we spent lots of time working with investors and educating them on multifamily, right? Like how is apartment buying, for example, works, how the structure works, and usually folks that we work with sometimes could be a first-time investor. They might think about, buying single-family homes. And for them, it's hard sometimes to go from like single-family and just thinking of appreciation, right? Because we all know, hey, buy low, sell high, right? Like that's the ideal goal. How we all can be buying the property right in 2011 and in 2020, it appreciated a lot. So I had over years, a lot of those clients where when we were talking about something a little bit more sophisticated, it took a while for them to learn. And I find that people still tend to kind of stick with what they know and what is safe. For example, same single family investing. So we thought it would be good just to get investors together and show them what else is out there, right? Besides a traditional kind of buying and hold single family kind of property. So that's my few words before we move forward.
I love it. Thank you so much for stopping me. That was perfect. Tyler, do you want to say a few words?
Yeah, the one thing I'll say is more of a compliment to you, Ryan. What Igor and I discussed before we jumped on this call today was that we're really grateful to be doing this with you. And the part of the reason why is I've seen a lot of people do a lot of partnership structures, a lot of different sorts of deal structures. And the one thing we've seen you consistently do is just do things right, structure things the right way from the beginning, so that you avoid a lot of the challenges that a lot of people face, even when they're more experienced in this industry. So Igor and I do a lot of land acquisition for builders and developers, and we're in that space, and we've been in that space for several years now. So we can see the trappings of success in many respects. And the one thing that we've just seen from you is that You're always so consistent. And the challenges we see others face, when we chat with you cordially and conversationally, we just never hear about these kind of lower issues. And whenever we ask you for advice about how to avoid them, your answers are so cogent and like spot on with how you structure things.
So man, you guys are going to make me blush here. Thank you so much.
If you share that with the community, I mean, that's what we're really here for.
Yeah.
And that kind of information needs to be out there more. That's why I'm so excited.
Yeah, and I really appreciate that, guys. And I will just say this: I've invested in 8 now private placement investment deals outside of my own company. I invest in all my own projects, of course, but outside of my company, Spartan Investment Group, I've invested with other operators, and I've made some terrible mistakes. And let me tell you, unfortunately, I've made some $50,000 lessons, because usually minimums are $50,000, and I've made some mistakes. And unfortunately, I haven't lost the money yet, but I probably have lost the money. And so my passion to educate the community on what to look for before making a decision on one of these deals is huge, because I want to make sure that somebody doesn't make the same mistakes that I made, because they don't need to make the same mistakes that I made, because we have this community that we're growing in this meetup group that will hopefully turn into a face-to-face someday. But for now, it is online. And hopefully when COVID is sunset, we'll all go to a community center or to a physical office space or something like that, and do this meetup and really create a community in Seattle, in the greater Puget Sound area, that focuses on evaluating good operators and good investment opportunities for real estate. And our vision for this group is, it's not, you're not always going to hear from me and Tyler and Igor or whatever. We're going to bring in people. We're going to bring in the SEC. We have somebody from the state of Washington, financial institutions, who looks at fraud and theft and Ponzi schemes on a daily basis, right? And she has volunteered to come speak at our group. We're going to bring in somebody like Jeremy Roll of Roll Investment Group. He runs For Investors by Investors down in Southern California. He's got, I think, 1,000 people in his group, with the largest passive investor meetup groups in the country. And he has invested in over 100 private placements. And, we're going to have him come speak to us. We're going to bring in operators that I have invested with, that have had good experiences with. One of the operators I've invested with has over $1 billion under management. It has, I think, something like 10,000 multifamily doors. So the goal of this is to focus on education, get that sophistication down, so that when we look at deals as a group, we can kind of collaborate and really decide, is the structure good? Have they covered all their bases, and things like that. So great intro. Thanks for bringing that back up to the top. I think that's a good way to start it. Good way to start it. So just a little bit more about me. I work for I co-founded Spartan Investment Group. We have about 4,000 storage units, RV parks, mobile home parks, pads in the United States, and we've syndicated about 30 million in private equity. We have a little bit over 100 million of assets under management. And we actually are doing 2 deals in Washington right now. We're building a mobile home park, and we are building a self-storage down in Black Diamond, Washington. So, the networking community, we're going to keep this presentation tonight short, because we actually want to open it up to the audience and ask the audience, what do you guys want to hear and see and talk about, so we can kind of better plan out this group. We want this to kind of be a small, tight-knit group. We didn't blast this far and wide. We didn't go on a Facebook group with 7,000 people and invite a bazillion people to this. We're not trying to pump up the crowd. We're not trying to get a lot. We're trying to get a high quality group of people that really want to focus on their passive investing career, because you can be a full-time passive investor where all you do is vet sponsors and deal operators and invest passively in this business, and be very lucrative. So this isn't a lot of hype. This is just focused on education. So if you have a friend or somebody who might be interested in this, definitely bring them into the group, and we want it to be a good community. So the third thing I had here was quality opportunities. Again, that's more about evaluating opportunities. This isn't going to be a big pitch fest or anything like that, but we should, somebody has a deal and they're like, hey, Ryan, I just got this deal put in front of me and I'm evaluating if I should do it or not. Tell you what, if you have permission, bring the deal to this group. We'll get it up on the screen and we'll go through it. We'll evaluate it as a tribe, right? We want to create a tribe of people that know how to really evaluate these deals and look for the pitfalls, because I've unfortunately been in some deals that haven't done very well. And then project site visits. Tyler and Igor, they're very active in the Seattle community, buying and selling land and doing their own projects. We have 2 projects in the greater Seattle, Washington area. We've got, like I said, we've got a self-storage. We're building about 755 units down in Black Diamond. We also have a manufactured housing community that we're building up in Squim, 217 lots. So, sometimes we're going to go to the site and we're going to do hard hat tours, and we're going to walk through properties, and we're going to see how this syndicated equity actually goes and works. So I put a little mission statement here. I didn't run it by Tyler and Igor yet, but I just, I think it summarizes what we want to enhance passive investor knowledge and the greater Puget Sound region, right? So this is a local meetup. I'm not advertising this nationwide because I hope that this will become something that we do face-to-face. So what is a syndication? We're just kind of going to go over some basics. A syndication is when a group of investors come together and they invest with an operator or a deal sponsor. So it's usually anywhere from $25,000 to $100,000 minimums, and they go invest with a deal sponsor who puts together the deal. So they do all the underwriting, all the financing, all the work. They find the property, they run the property, and the investor does nothing but passively invest their capital. This can be for real estate development, it could be for single-family homes, it could be for multifamily, self-storage, land deals, whatever it might be. So basically, you're making a partnership with a team that has experience and who is going to do the work for you. Tyler really gave me some good props here. Required paperwork. We're going to go through all this stuff. So, we're going to put real operating agreements on the screen. We're going to talk about, hey, did you know that your operator says in this operating agreement that he's allowed to take your money that you invested in this specific project and lend it to other projects? Do you know that it says that in the operating agreement? And you go, no. And you're like, yeah, it says it right here, right? So that happened to me, unfortunately. It was buried in the paperwork, right? And so that kind of sounds like a Ponzi scheme, and I actually kind of think it is, but it said in the operating agreement the operator could do that. So we really want to understand operating agreements, what's in them, what the operator is allowed to do, what they're not allowed to do, so you can bring up those objections with the operator. Offering memorandum, that's the sales prospectus that it's just nothing more than marketing. Private placement memorandum, purchaser questionnaire, subscription agreement, and then making sure the operator is actually a bona fide. They're actually making their registrations with the state. So if you're a Washington State investor, you're investing in a syndication, there's blue sky filing requirements, Form D requirements that we'll dive into on another topic or time. But what is a capital stack? This is kind of when these syndications come together, you really want to understand where the money's coming from, how much of it is being piled up in a stack, right? And then where it all goes, right? This is a real deal that we did where we raised $2.3 million of syndicated equity. We took out a bank loan for $5.2 million. We had a total capital stack of $7.5 million. And $6 million went to buy the property, $1 million went to construct it and add on. We took $250,000 of project fees for putting the deal together. It's really critical to understand that these syndicators are making money on doing these deals, right? So you want to understand how they're paid and when they're paid. So about half those fees are paid up front in this particular instance, and then the other half are metered out over key milestone completion. So when the renovations are done, maybe there's a little bit of project management fees are dripped out. Where I've seen some operators, they take their project management fees the day the deal closes. They don't have the staff to run the deal. They're in a Maserati the next day. Okay, so like and then they're off to the next deal, right? To raise their money and take their fees and buy their nice cars, right? So, we really just want to make sure that you understand how this stuff is all coming together and where it's all going. And then operating reserves. Obviously, we're in the middle of a pandemic. Does the operator have enough cash in the bank just sitting there, not planned for operations or improvements or contingency or anything, just above and beyond cash sitting in the bank, ready to do the deal? So that's one important thing there. So tonight we're going to talk about a preferred return. What is a preferred return? This is the only thing that we're going to go deep on tonight, and we're going to spend about 20 minutes on it, maybe 10 minutes on it, and then we're going to talk about the rest of the meetups. So cumulative versus non-cumulative, right? What is that? So imagine you've got an operator who says you've got an 8% preferred rate of return. So that means that 8% of your investment has to come back before the operator splits any profit with the deal. So if it's an 8 pref, it has no meaning. It does not mean that the deal is going to produce that income. It just means that you have the first claim to that income. So if you invest $100,000, an 8 pref would be $8,000. So you would have to be paid $8,000 before any splits happen with an operator. So $8,000, and that's maybe $2,000 a quarter if there's quarterly distributions, or so on and so forth. Some operating agreements make them cumulative. Some operating agreements make them non-cumulative, and it's very important to understand that distinction. So just imagine this. Imagine it's cumulative. That means that it's rolling throughout the entire investment time. So if you have $8,000 preferred rate of return, the day that investment closes, you start accumulating a preferred return. So let's just say, for all intents and purposes, the deal had no cash flow, produced no income. It was a development deal or something like that that offered an 8 pref. That means that in 5 years, if that deal made no cash flow whatsoever, you would be owed 8 times 5, so $40,000 before any splits would happen, right? So $40,000 is owed to you first on any profit. Now let's say there was $100,000 of profit. You would have to get your $40,000 first because it's a cumulative pref. Then the remaining $60,000 would be split based on the waterfall or based on how the operator takes ownership, right? So if the split was 50-50, you would get $40,000 first, and then the $60,000 that remains in the profit would get split 30-30. So you would actually be making $70,000, and the operator would be making $30,000. So in that case, it's kind of like you're getting a 70-30 split in that scenario versus, hey, I thought the operator said 50-50. So a cumulative pref can be very powerful when you're doing one of these syndicated deals. So ask the operator, is the preferred rate of return cumulative? If it's non-cumulative, that just means if you don't hit your 8 pref in the first year, too bad. It may start the next year, but it doesn't start, it wipes out every year. So you may get the rights to the first profit in the first year, but then, if it doesn't hit the next year and it's not cumulative, you won't be made back up. You won't get that $40,000 at the end because every year it goes away. So make sure it has that verbiage to talk about cumulative versus non-cumulative. Now let's talk about true preferred rate of return. This means that you are actually getting a split above, before the pref. So we kind of talked about that initially on what true preferred rate of return is. And then a preferred rate of return with operator catch-up. So imagine this. This is very, very important, right? That means that the operator has to be caught up after you hit your pref before there's a split. Okay, so a lot of operators, oh, my splits are 80-20, right? 80% to the limited members, 20% to me. But there's catches, right? There's catches in how the waterfall is set up, and the biggest catch is how the preferred return is calculated. So in this case, a preferred return with operator catch-up means, okay, you've made your $40,000, right? So we get to the end of 5 years, you've accumulated a $40,000 pref. Now the operator has to catch up. So the operator then gets $40,000, right? And then there's a split. Okay, so now the operator made 50 and you made 50. So even though it was a different split, right, there's actually an operator catch-up. Does that make sense? You guys explained that okay? And then sometimes there's no preferred rate of return. You know, sometimes operators just say, nope, I just split everything 50-50. Dollar comes into the net distributable cash as $1. We split 50-50, 70-30, 80-20, so on and so forth. So there's a lot of different ways to set up the preferred return. There is no market, right? Everybody asks me, well, what's market? You know, it depends. I mean, it depends on what the splits are, depends on what the hurdles in the waterfall is, and you know, there's a lot of things that go into that. So does anybody have any questions on this before we go to the next slide? Next slide's pretty good, actually. I don't see any questions in the chat box.
Hey, Ryan, I'll just mention real quick, because it got a little bit complicated there. Usually the reason why it gets complicated is trying to benefit investors. Like, the reason why you offer preferred return is because you either say, hey, just because I want to make sure that this deal looks really good for someone, I'm going to offer that, or somebody asks you for it. But usually it's to the benefit of an investor.
That's a great point. Yeah. A preferred return benefits you. But you know, when you're kind of looking at deal structurings, you know, I just wanted to kind of make the point that there's different ways to structure it. But great point. That really brings it to 30,000. So when you see a preferred return, that's a good thing. So then you just want to know how the mechanics of it work. So good point, Tyler. All this stuff is covered in your PPM, so your private placement memorandum. So your waterfall structure. We're actually going to go over a real waterfall structure tonight. So we're gonna show how it reads and what it means, things like that. So this is a great chart. I just ripped this right off the internet. So this is a hypothetical scenario for an 8 pref. So here we are. Explain this X and Y axis here. So here's your cash flow. So let's say this deal has no cash flow in this year. In the second year, it makes, or I don't even know how they're doing this, if they're doing this by month or whatever. Anyway, but this is the profit actually coming off the deal, right? And the blue represents the investors, us passive investors, right? So this line right here is the 8 pref. So you're going to get all profit until there's enough profit to satisfy all of the investor preferred returns. Then there starts becoming a split. So for example, I have a deal right now that hasn't hit the pref for 2 years. And now we're just starting to exceed the pref. But because it's cumulative, I owe the investors that money from previous years because I didn't hit the pref in previous years, right? So sometimes you might see huge cash flow in a deal on year 3 or year 4 projections, but then in year 5 it goes down. And you're like, well, what happens in year 5? Well, the pref your preferred return account gets balanced. And now the operators starting to take their split, right? So this red bar represents what the operator takes. So you can see the alignment of interest, as Tyler mentioned. There's a huge alignment of interest because the investors are making all the money first with a pref, right? Until the operator is really performing or the deal's really performing, then they start getting their upside. So great point. Any questions on this or any additional thoughts? All right, so here's the brass tacks. This is where you read about it. So this is actually one of our PPMs. This is a deal that we have live right now. And this is distributions of net distributable cash flow from operations. What that means is this is money made from the deal operationally, right? So this is us selling storage units, it's selling a tenant insurance, whatever we're doing, it's renting the units and we're collecting the cash. And when we close our books for the month or for the quarter, we're going to have hopefully we'll have net profit and there's net distributable cash. So everything's been paid and we have money left over, right? So we say in our PPM, this much shall be made quarterly and shall be made in the following priority order. In this case, there's 3 classes of passive investors in this deal, A, B, and C. First, to members holding A, B, and C units in proportion to their respective preferred return balances until each member's preferred return balance is reduced to 0, right? So meaning that we have to give you 8% on a cumulative basis until those preferred return balances are 0. After that, second to members in proportion to the respective percentage ownership interest. So this essentially means that after you hit your pref, there is a split. And the split will be outlined in the PPM as well, whatever that might be. Make sense? Any questions on this? This is an easy waterfall. This is very simple. We can look into more complicated ones. Sometimes these are like 9 or 10 lines long. Sometimes there's more hurdles. And it eventually gets to a split, but not until it gets, goes down the wall. This is essentially a waterfall. So plan of distributions. This is also, when you look at a PPM, you want two things. You want how the plan is to distribute cash from operations and how to distribute cash when there's a sale of the property or a refinance. So if you're doing a flip, there is no cash from operations unless it's going to be rented out as a rental property. But if you're buying a multifamily building, or if you're syndicating into a multifamily or a self-storage that's operating that has customers, this is the way that your cash is paid to you when the property is sold or refinanced. So distributions from dissolution or refinance shall be made in the following priority order. First, to members holding Class A, B, and C units, those are the passive investors, until their capital cash contribution balance is reduced to 0. Capital contribution balance, as a tongue twister, is what you've invested. Your capital account balance is your initial investment. So that's your 50K, your 100K, right? You get your money back first. You want to see this happening in every deal you do. You always want to be paid back first of your initial investment. Then it goes to members holding Class D units, and in this case, our company is Class D, in proportion to their cash contribution balance. So that basically means that if the operator put money into the deal, we get our money back, right? I mean, that makes sense. Not a return, but just get our money back. And then third, it goes to the investors, the A, B, and C investors, in proportion to their respective preferred return balances, until each such member's preferred return balance is reduced to 0. So again, in that situation, I said, if there was no distributions from operations, that has to be paid at the end first, before this fourth step, which goes into their percentage ownership interest. Returns will only accrue, and this is important too. So when does your return balance start accruing, right? So let's say an operator is buying a deal in September and you sent them money in July, right? Do I start accruing a preferred return balance, preferred return, when my investment goes into your bank account, or does it start when the deal actually funds, right? And in this case, returns will only accrue from the closing date of the purchase of the properties until the closing date of sale or refinancing of properties that produces a return of capital contribution. So in this case, when the property is actually purchased. So it's a critical thing. Some people do it. Very rarely I've seen from the date that your money goes in. They might get a little bit more interest, or they might get some type of 1% or something like that while it sat there. But generally, your preferred return account balance starts when the property actually closes. That's all we have for tonight. So we wanted to kind of keep it short so that we could get feedback from the group. Like I said, Tyler, Igor, and I are very well networked. We can get a variety of different topics and things like that. I think there's going to be a website pretty soon that we're going to put up, but how do we, hold on, bear with me here. I've not really done one of these, but can I make it live where we can talk to everybody? How do I do that? You guys know how to do it? Let's see.
I personally believe we had to set it up before we started.
Oh, shoot. Okay.
But I think we do have some questions.
Oh, we do. Okay, good.
That are coming up in Q&A or in chat. So we got the first question. Yeah. Actually, Stefan, that was my question. I was just going to ask that question. So yeah, Ryan, do you see it? Like, can you speak to the differences between Class A, B, C units versus Class D units?
Yeah, so let me just really dumb this down. So you could call it a giraffe and a rhinoceros unit. Okay, so Class A doesn't mean somebody's special. It doesn't mean that they're in priority or anything like that, unless if it says so. Okay, so when it's Class A, B, and C, a C person is not any, in this situation, wasn't any worse than an A person. So understand that, right? Because sometimes investors think, oh, I'm a Class C. Why? Well, why is he a Class A? Is he better? Is he higher in priority? No, it's the same. Unless if it says that a Class C gets differential treatment, it could be the same. So in this case, typically what you see in a standard investment, you might just see two classes of investors: the general partner, which is the operator, and the passive investors, right? So that might be an A and a B. So Spartan always just is, we're always the B in a deal, right? So we're the B in class of investors, and the passive investors are the A. Again, doesn't mean anything unless if it's written that it means something, like you get a preferred return. In this particular deal, we actually created three classes of passive investors. A-class investors who invest less than 500,000 get a 50-50 split, and they get their splits accordingly, right? They get in this particular deal, they got a 7 pref with a 50-50 split. Investors that are B investors are repeat investors. So we actually carve out a 5% ownership bump to people who are repeat investors with us. And so their split is 55 to them, 45 to us. So we give that part up. Class C investors are anybody who invests over 500,000, get a 70-30 split. So they get a 20% premium over a Class A investor. So it's all about just how their splits go. Now, the A doesn't get paid first, or the C doesn't get paid first, or it all happens proportionally at the same time. So for example, if one guy's an A and he invests 100 grand, and one guy's a B and he invests 100 grand, they both get their prorated split at the time there is a distribution from cash, sale, or refinance. Did I answer it?
Yeah, that was really good. One note I'll make that I've seen other people do, and it just depends on how you set it up, is depending on the risk level at what stage of the deal you're in, you can usually offer something different. So, you know, as an example, like if you're paying for all the permits yourself and you're taking on all the risk, you can say, okay, well, I'm going to open this up for an investment opportunity after I already take away all this risk. But if somebody wants to be part of it beforehand and they believe in the project the same way I do, then we can structure a way for you to get compensated a little bit more accordingly to that increased belief and risk in the project. Or I'm just giving a very simple example, but you know, since you can piece it out in many different risk levels, that's one element to that as well.
No, that's excellent. You know, when we did our self-storage deal, you know, there was years of entitlement, right? Permitting, right? And there's a chance that you get denied your permits. So there's a tremendous risk that goes into that stage of the deal versus somebody who comes in on a fully entitled project that you can just go right out of the ground on, right? So there's different, and you can say, hey, we're going to give you a 80-20 split, you know, to come in early, which is going to give you a better return, but more risk, right? So that's a great example, Tyler. I'm really glad you brought that up. That was spot on. Yeah, sorry guys, we didn't make this live. We were going to have everybody to be on camera, and we were going to make this a little bit more interactive. But we're learning. We'll do it again next month when we have our meetup. So.
So we got another question from Alia. Is there a limited number of C class in your example, Ryan? No more than 3-4.
No, the maximum investment is 4 million, because that's the maximum that we're raising, and there could be as many as 8 Class C investors, or 1 Class C investor that takes the whole thing. So there really is no minimum. There's a maximum because there's a maximum amount that the offering is being raised for, but they all could be C investors. That's a possibility. The way it's actually shaped out, we have I don't know, maybe a couple 100,000 left to raise or something, but the way it's shaped out, I think we have 2 Class C, I think about 1 million Class B, and the rest Class A. So, or no, vice versa. So about a 2 million Class B, and then the rest Class A. So new investors that invested under 500,000. Good question.
A question is, do you think, is there any like a quick, not a slide, but maybe example of those returns? I know that every deal is specific, like without going in too many details of how, I know we'll get to that at some point, not today, but just if we show like one page of, let's say this is what the return is, this is the split. So we kind of put more visual to the information that we went through today.
I'm pulling it up on the slide right now. Let me just, give me just 2 seconds.
Good time.
Let's see here.
We got another great question actually by Veronica of how to search for such deals. So maybe you could mention also of 2 types of offerings that usually are there.
Yeah, so let me give the first visual here, and then I'll answer that question.
Sounds good.
So this is a live example of a deal that we have now, where there's Class A, Class B, and Class C. So minimum investment 50,000, 50,000, 500,000. So you have to be a $500,000 investor to be C. And then this is what the ownership is for that investment amount. So in the deal, everybody gets the same pref. This is the operating returns get a little bit bigger. Operating returns are from cash flow. And then the sales upside is where you start making more money because the split is larger, right? Total return goes up, and then target annual return goes up, and then the equity multiple gets a little bit better when you're Class C. So here's the breakdown. So whenever I look at a deal, this is like the most important thing that you don't want to get too focused on yield, but this is what I really like to understand. What do I get in year 1? What do I get in year 2? What do I get in year 3? What do I get in year? Where's my money, and where's the money coming from? Right? Is it heavily weighted on the sale, or is it heavily weighted on cash flow, or is it kind of a mix? So I like to see, okay, I'm going to make money on my liquidity event, 22,000, and I'm going to make about 22,000 on the operating returns. So this deal is kind of like 50-50. Half the deal comes from cash flow, half the deal comes from upside. For me, this is, as a passive investor, I love deals like this because I don't like deals that are heavily weighted on the out sale, because that's such a future metric. That doesn't make it a bad deal, but it just means that, I have to wait, right? I'm a little impatient. So I kind of like the cash flow. I like the coupon every quarter or every month. But this really breaks it down. Over here, Class B members, you can see, one interesting point. Again, they have a little bit ownership, but look at the cash flow. It's identical in year 1. And the reason why is because this is based on a $50,000 investment, and they haven't hit the pref, right? Year 2, they still haven't hit the pref, right? Year 3, they hit the pref and there's a split. So you notice this has got a 5% increase, so the returns are a little bit more on the distro. Now I notice how it peaks, then it drops, right? It's because the pref has been completely paid back, right? And now the deal is splitting with the operator in year 4. So the operator isn't making anything on the investment until year 4. And then year 5, it goes up a little bit, and then that's the end. And then the sale is projected in year 5. So you get a total return of $46,000 over 5 years and your $50,000 back. So, in year 5, you're expecting to get $96,000 back, $96,004. And the same thing here. You can kind of see the split gets a little bit better in year 3 after the pref is met. And then it's just a little bit better as we go. You're just putting zeros basically to the end of these. So good question.
I think that touches.
And this is where the targeted analyzed return is coming from. That's where the number comes with.
Igor, that's going to be our next meetup. So we're going to go through. No, that's a great point, because there's a standard way of measuring all of these things. So, you got minimum investment, ownership. Ownership is kind of important, for your split purposes. But really, it's, what is the deal going to do, right? I mean, and that's kind of my philosophy. So you've got target annual return. This is adding these two numbers together, these 22,149, 22,646, and then dividing it into the number of years, right? That's how you get that 17.9. Equity multiple, this is simply your initial investment times 1.9, which is 44,795. That's your equity multiple. So you might see like, oh, wow, this has got a 3x multiple, but it takes 30 years, right? So, you know, a high multiple doesn't really necessarily mean a good deal, because if somebody came to me and said, oh, this got a 2x multiple, I would say, well, how long does it take for me to get the 2x multiple? If it's 5 years, okay, it's pretty typical for syndication. And then target peak cash flow, that's just your, the target peak. So that the peak of the business plan is going to give you a 10.9% cash on cash return. So pretty healthy. And we'll do, you know, if the group wants to, we'll do a whole briefing on how to read an underwriting file. So we'll go through, we'll teach everybody how to underwrite or how to analyze underwriting. I think that would be very beneficial. So how do you search for such deals? You network. That's kind of the point of this group. You know, these are private placements, so they're not necessarily well advertised. Maybe we can do a little slide on that next time. You know, kind of where we find operators, how we vet them, things like that. I encourage people not to look for deals. I encourage people to look for operators and make sure that you're dealing with a full deck on their team, right? So, and then when they have a deal, you're on their list and you get, you know, sent a deal. That's typically how it works. How different is this compared to investing in a company like UDR? I'm sorry, what is UDR? I'm not sure. I'm not familiar.
Yeah, we'll have Rahid specify us what UDR is, and we'll come back to that question. There is the next question of Amit. What is the tax impact? Does one need to open an LLC? And then we'll come back to UDR.
Yeah, it's a great question. So, okay, I get this question all the time. Do I need to open up an LLC or whatever, right? Okay, so I'm going to give this caveat, and then once we get this disclaimer out of the way, then I'll answer the question. I'm not a tax attorney. I'm not giving tax advice. I'm not your general counsel. I'm not your legal counsel. Seek outside counsel, and definitely seek, you know, contact your tax professional, your legal professional before making any decisions. So with that out of the way, here's what typically happens. In these syndications, I see 50% of the investors come in under their personal name. I see 25% come under an entity name, and I see another 25% come through a living trust or a IRA or some type of self-directed retirement account. So do you need an LLC? Absolutely not, in my personal opinion. Not my legal or financial opinion, but just between friends. No, you do not. Is it a good idea? I don't know. Ask your attorney, and they better have a really good reason why you're going to have to pay to set up an entity, pay filing fees, keep up with corporate formalities, and probably pay them to do all that for you every year. They're going to have a really good reason why. Because when you invest in these syndications, you're typically investing in an LLC as a limited member, so you already have protection. So if somebody slips and falls at the property, you are not on title. You are a limited member of a protected LLC. So why would you need another layer on top of that? I mean, it could be another layer, but you know, it's headache in my opinion. Publicly traded company. So UDR, they make large apartment complexes in Bellevue, Element Apartments, and many other apartments are built by UDR. Publicly traded company, you can buy their stocks. Okay, so that's a great question. So publicly traded companies and REITs, your returns are subject to speculation. So that's massively different. So those companies typically don't give you any tax advantages, and you're subject to wild speculation. Let me give you a great example. You don't need to invest with Spartan to own self-storage or invest in self-storage. You could go and buy a REIT, public storage, publicly traded company, right? And when COVID hit, the REITs dropped 15%. Not because of performance of the asset, but because there was speculation that whatever was going to happen during COVID, right? So when you invest in a publicly traded company, you subject yourself to speculation, right? My properties did quite well, right? Our syndications, there was some deals aren't doing as good, right? Of course, COVID had impact on some of our assets in the Permian that rely on oil production, right? But generally, if you were in a self-storage deal that was stabilized, there is no speculative upswing or downswing in that. So you're investing in that project and that project only. So if COVID hit and nobody moved out and everybody's paying on time, guess what? You still earn your return for that specific investment. When you invest in a publicly traded company, you're investing in a pool, in lots of deals, and again, speculation, and just, I'm not saying that's bad or good. That's just what you're investing in. That's what's different. The other thing you don't get is you don't get the depreciation of that asset. So for example, when we buy a storage facility, we go through cost segregation and bonus depreciation, and the investor ends up with a K1, and they get a loss in the first year on their tax return that typically shields all of their passive income on that investment from paying any taxes in future years for that particular investment. Great question. That sparked a great conversation, I think.
I think what we will do is specifically on taxes. We might have someone who will, I don't know, maybe Mark Hinton would be also a good example. Someone who will just actually talk on taxes itself and how taxes work besides
sure.
cash flow and appreciation and liquidity events. So that would be a good one for us to have a totally separate event on.
Yeah, and just because this is the first event, and I really want to drive home like the intent of this group. We're not going to talk about theoretical tax situations or things that might not apply to you as a passive investor. We're going to get down to, you are a passive investor, you invested $50,000 in this syndication, and you got a K1 sitting in front of you, right, in March. What does this mean to you? That's the focus of this group, not how cost segregation works or bonus, that kind of stuff is for the operator to figure out. It is important to have that knowledge, but I want you to understand every word, every sentence, every line in a deal, so you can go into something eyes wide open and completely understand all the benefits and a potential risk that you're taking on an investment. That's kind of the goal of this group. So, but yes, we're going to hit that for sure.
Guys, any more questions? We still have some time, plenty of time. So we got another one from Stefan. Can you speak to the risk? Let's say the project is impacted by X that alerts the timeline returns possible. How is that handled? And I think, Ryan, I know we've got quite a few good examples, especially with that tornado that hit our mobile park and bunch of crazy things. So, but just give maybe one story of what happened and overall general answer of what usually happens.
Okay, so I'll start with the scary part, and then I'll kind of work from there. When you invest in these, you could lose all of your money. That is a risk you're taking. You could lose all of your money, and this group is to expose the truth in these syndications, and again, come into things eyes wide open. So that's a possibility. You could lose your money. The upside is very good. The upside potential is very good. You could make 2x and 5. You could make more than that, right? And generally, these investments are pretty, they're fairly, safe bets, right? But you're betting on the operator, right? You're looking at how they're capitalized. Are they going into a project with not enough reserves? Are they over leveraged? Are they relying on heavily on market conditions? Do they have the experience in what they're doing, right? We got hit by a tornado on a property, completely destroyed the property back in March. So we bought an RV park in the Permian, West Texas. It relies on oil workers. It cash flows very well. We bought it at a 17 cap. We had already distributed a 10% cash and cash to our investors. Did very, very well. We only need 20% occupancy to break even. Good investment. We had a couple $100,000 in reserves, and guess what? We got hit by not only COVID and a war between Saudi Arabia and Russia and oil, but about a week later, we got hit by a F1 tornado and wiped the whole park out. And so does the operator have insurance to cover that loss? Does the operator have the ability to dispatch teams and rebuild that entire park, which we did. We rebuilt everything in about, 6 or 7 weeks. And then, then we, restored the park occupancy to 80%. We're cash flow positive now, so I always like to say, make sure you vet the operator more than you vet the deal, because you could be looking at a very, very good deal and an operator that does not know how to operate it or wouldn't know what to do in a situation like that. So that's another part of this group. I want to introduce people to good operators, good opportunities. I have an abundance, and I know Igor and Thomas have this, or Tyler have the same thing. We have abundance mentality. There is enough money to go around. There's enough deals to go around. We just want to get the good word out on passive education, right? So for passive investment opportunities. Stefan, I will answer this. On one call, we will go through the PPM, and the private placement memorandum is the document that lists all of your risks in a specific deal. So we will go through that at one point.
We got another one from Amit. What kind of investments do you think one should invest in given current situation? Very, very open, kind of ended question. Everybody could have different ideas on this. There are a lot of things, but yeah, Ryan, what do you think on this?
I love stable storage. But that's biased because that's what I offer. I think that the storage was the highest performing I know storage was the best performing asset class in the last 2 recessions, and it continues to perform. All of our stable storage properties are doing exceptionally well right now, and I think that the fallout really hasn't happened from COVID yet. Yeah, we've had some unemployment and things like that. We have a lot of stimulus money, and I think that as there's job loss, relocation, downsizing, moving, job relocations, things like that, I think that people are going to need storage. And that's why it did so well in the last 2 recessions. So I like that. I'm very bullish on the Seattle market. I think this market is not going anywhere anytime soon. I think we have some of the most diverse employment and job opportunities there are. So I think that being in the residential space in Seattle is probably not a bad place to be, depending on what you're doing. Mobile home parks are very good. Mobile home parks are the lowest form of housing on the food chain. So when people can't afford their Class A apartments, they go to Class B. The people who can't afford Class B go to Class C. But there's always somebody going to a mobile home park. There's always somebody who needs a space in a mobile home park who can afford it. And I think that's a very lucrative investment. And I think workforce housing. I think those 3 kind of asset classes are very good, 3 or 4. But it depends a bit on your your goals, where you are in life, what are your cash position, what's your preference, what's your risk tolerance. Those are things that, if it's purely cash preservation, I think the best risk adjusted returns that you can get into are probably in mobile home parks, or some sort of multifamily, where if you're a little bit more risk tolerant, development's great space for that. I think people who can capitalize during these times when banks are not lending and the market is drying up, but inventory remains scarce. I think you're rolling the dice a little bit, but I think development right now is very lucrative because there's a lot of developers that have stopped building. So assuming that there's a market for those properties when the recession is over and the pandemic is over, you could be in a very good position to have the inventory that everybody seeks, right? So just depends.
I probably would just add a few words, back to what you said. There are a lot of deals out there. Every single one of those operators, whatever they do, right, they would believe in that deal that they do. So based on whatever that asset class is, I think there could be lots of different good arguments of like, hey, why this is better than this and that is better than that. But the thing is, there are lots of good opportunities out there. And just like Ryan said, it is about that operator, someone who you trust, who you see a proven track record and things of that nature. And then do your research as well. It's always good to go back in time, right, and see how did this asset class did over the recession. That's something that we always try to look. And yeah, so Amir, I hope that answers that. We got another great question from Veronica. Can you negotiate terms of the specific project as an investor? I assume the negotiation is between the operating and passive investor.
Yes and no. Okay, so if you're partnering with a small enough deal where you're the sole capital provider for the opportunity, I would say you could absolutely negotiate. If you are investing in a syndication with 45 other investors, there are things called side letters. I think they're a little bit, you can make a side letter. We don't like doing that just because I feel like it's unfair to those who didn't negotiate, just for purposes of transparency and things like that. But there are side letter agreements you can do. We've never done them, but if you're partnering with somebody and you say, hey, like my business partner has done like 36 different single family homes and he's got various partnerships, and he basically, takes a down payment, goes, buys the house, and he does everything and splits the deal with them, right? Highly negotiable situation. You could negotiate in that situation for better returns. But generally when it's a bigger syndication, other than a side letter or sort of some of the pre-negotiations that that the operator sets out, like in this case, hey, if you invest over 500,000, you get a bigger split, right? Or if you are a repeat investor, you get a bigger split, right? So those are generally, I like to see those types of negotiations up front. So it's like, hey, we're offering different opportunities based on how much you invest.
Gotcha.
I hope that answers the question.
And could you specify for me a little bit, what is the side letter? Like, just...
It would enable you to carve out a specific investment for that group or for that investor that comes in.
Gotcha. Okay,
We could talk about side letters on a different call. That's a good idea.
Yeah.
We're getting good topics loaded up. So this is good.
Yeah. Veronica, thank you for your question. Great question. Anyone else, guys? We do have time. Don't be shy. I know there are a lot of different questions in here, but yeah, anything that comes in mind, just put it in the chat. Anything else we have to add to this? I think we kind of did it good for the first kickoff. Or you could maybe also say, if you don't have a question, maybe put in the chat box of what could be your preferred topic that you would want to look into deeper over the next meetup, because we have lots of topics, but we don't have anything like set in stone that we're doing exactly for next time. So if anything that you want to learn more for the next one, just put it in the chat.
1031 tick. I love it. Yep. We'll talk about that We'll talk about that on a call. No problem.
Okay, we got that.
Any opinions from the group on frequency? Anybody want to comment on maybe how often you want to meet, how often you want to go through things? Please let me know. So, also, if you have any opinions on meeting location. So I live in Laurelhurst. I live right by Children's Hospital. I was eyeing the Laurelhurst Community Center, which is right by University of Washington. Seattle's tough, right? It's a north-south city, a little bit to the east too, but obviously with traffic and things, you want to be respectful of that. We also wanted an environment where it wasn't loud and, if you guys have any opinions on that, we're still very open to this. Obviously, it's very easy to sit down and do this on Zoom. And we obviously frequency isn't as difficult, but we definitely want feedback. And, I saw 1031 exchange, how to vet investments, how to find more opportunities. These are all things that we can do. So Zoom meetings are great. Yeah, I agree.
Yeah, it will take some time for us to get it in person, but we just want to let everyone know that that's the goal in the future. And
at least October, right? I don't think there's not going to be anything in person to at least October. Yeah, unfortunately. Or a vaccination, whenever there's a vaccine.
This is Yuri, actually got a great point too.
Yeah.
It would be nice at some point to go over deals that went bad to learn the lessons. I think
Yuri, I'll do it, but man, it's going to be painful. You guys are going to think I'm an idiot, is really what you're going to. No. I went into a deal. It was 2015. I'm trying to make, our goal here is to make this the smart money, right? I will heal you, Ryan. Oh yeah, you are a pain medicine, a pain specialist. So thank you. I appreciate that. I need more of a psychologist though in this situation. But yeah, it's yeah, we can go over a bad deal. Yeah, I'll expose the whole thing. I'll tell you why I thought it was a good deal. I'll tell you why I sent the money in and what I wish I would have known before doing the deal, and maybe what kind of clues were being put down that made me go. But now my little red flag would pretty much immediately go up. So the thing that I just would say is I'd be triggered to say no to everything, and you'll go much faster in this business because nobody's going anywhere and nothing is once in a lifetime, and that's really, the sophistication you should have, right out of the gate. There's no once in a lifetime. There's plenty of deals out there. So just, having that in mind, I kind of like got my retirement account converted, and then I was like, all right, next deal that walks by, I'm going to get it, and that's what I did. And I made a bad decision. So, but I'm happy to share that with you we'll do a briefing on that. Well, a lot of good topics. Maybe we'll do that next time. That'd be kind of fun.
We could do it next time. We could maybe do a few like deals examples, just kind of like what the deal is. I know that we touch a little bit on preferred returns, but altogether just so people kind of see what it looks like. Another one that you just mentioned that I'm thinking for the next time, we could talk also where the money could come from, right? Like you talked about retirement accounts and how those technicalities work. This is another good one. Exit strategy can be another topic. We'll definitely touch on that. One thing before I forget, we wanted to mention that either we do this next month or in 2 weeks, which we'll figure it out, but we'll definitely invite you again. We'll send you a recording of this, and we want you to bring one friend, one friend to our next meetup, someone that you think will enjoy this as much as you do, and that's our ask to you. We commit to provide the best knowledge and information that we possibly can bring the value to you. You please bring one friend with you. So that's before we forget.
Yeah. So Aaliyah, yes, we will list out 6 topics, maybe 10 topics, and we'll put it out to a vote, and we will prioritize. So yeah, that's a great idea. We want this to be fluid. We don't want to just sit here and just ramble on about stuff that you guys don't care about. We want to make this very engaged. And and Igor, just to piggyback on to bring a friend that actually is interested in this. Don't just bring anybody. We're not trying to make this 500 people. We're trying to make this folks that are interested in the space that want to really sharpen their axe on their level of sophistication. So. Talk about different deal structures and things like that. So awesome. Well, man, this was great. We'll get that list together. We'll get it out to the group. Do we have email addresses? I guess we have email addresses on the registration. So perfect.
There is that, and also I think on the meetup, if you hadn't yet, just please make sure be a part of the group. You can join the group, and I believe that if we send things over Meetup, you'll get an email through that as well. So
perfect.
Awesome. I think this is it. I don't see any other questions unless any, we'll give it another 10 seconds. But please also include some information about your firm and offerings.
Yeah, here I can send that out. So we're my company, you guys can put your company here in the chat box. So
yeah.
We're SpartanInvestors.com-investors.com. We do have an open offering. It's almost filled up, but we have an open offering now in storage. We do a couple offerings a year. So, but yeah. And then here, I'll put my email to everybody if you guys want to put your email in there too. And I think this is all on the Meetup page, but I'm not sure.
Yeah.
I also have a YouTube channel. Spartan Investment Group has a YouTube channel, and we have webinars on there. So there's a lot of tax and investor webinars that we make available. We did a webinar once a month last year, so we have quite a bit of content that's connected to our website and on our YouTube channel. So, well, very good, everybody. thanks for coming. Thanks, Tyler, Igor. We finally did it. I don't know how long it took us. It took us like 4 months to get this going, but here we are. And we're excited to have you guys. Thank you so much for coming. This is a very, we want to make this our own little tribe of strong investors. So if you have any feedback or suggestions, we are going to take it and we're going to run with it. So have a great night. Enjoy the good weather, and we'll talk to you next time. And we'll send out the recording by the way too. So
we'll send out recording, and we'll make sure to book next event here very soon. So we'll invite you to the next event shortly. So thanks so much, everybody.
Thank you, guys.
Okay, bye-bye.
Bye.